và nó sẽ được tính khấu hao. Vì tại vì hai cái này là khác nhau.
Cái chi phí của em là em bắt buộc phải trừ vào để mà em
Okay, so good evening, everyone. So it is 7 p.m. So we're gonna begin the morning me. So thank you for saying more. Good evening for you guys. Good morning for me. So I guess you can hear me, right? Because you can say hi, so it means you heard, and you can see me as well. So we are good to go for a new session. Just before beginning, I would like to I would like to know if you had any question about yesterday, about the bonds and everything. Or you can still ask me later on, right? If you have any question. I shared with you the solution to the exercises, to the bonds already, and I keep on going, changing the what I call the blackboard, which is the Excel document where I take notes. I rename it day after day with the name of the day, right? So you can find my notes there if you have any doubt about calculation. Again, it's something I do by talking to you. So I don't know, maybe you can have somewhere some little mistake somewhere, but if you have any, you ask me. But globally, it's more like if you want to better understand how a thing was done, and if not, you still are also, maybe it's more reliable, by the way, the video of the session. So it works quite well. So this is recording now, so for today we should be okay as well. So it takes 1 or 2 hours to render when it's finished, yeah. And so I upload that on my cloud here in my university, and I share the link with you. It seems to work, so it's okay for me. So we are kind of okay on schedule. So we are not late, but we are not early. So we still have to keep on going at the same pace. So our job for today, we certainly will be to finish the chapter about the stocks, which is, I think maybe a little bit easier than bonds. I don't know. Maybe I prefer that. That's for sure, because it's more corporate finance than market finance. And hopefully we can begin the chapter about the investment rules afterwards. So we are on schedule. So I will keep you updated for the rest of the week. How we still are gonna spend all Thursday on working in groups and presentation, and then on Friday, Saturday. So it should be okay. It's just I will tell you the timing of it. So okay, so now it's time for me to begin. Okay, so I go back. My first thing to do is to go back to to my PDF document, which is about the slides of the course, right? So we just finished yesterday to calculate the price of a stock using this formula, right? And so it was for 1 year, for 1 year investment horizon, right? So let me reorganize a little bit things here. Yeah, okay, because I don't see the chat anymore, sorry. Yeah, that should be okay like this. Okay, so yeah, so what we did is that we calculated the value of a stock if we consider that we keep the stock only 1 year. So as I said, we can find a sort of a parallel between bonds and stock when it comes to the cash flows we expect to receive. In the bonds, coupon bonds, we expect to receive coupons every 6 months or every year, and then the face value of the bond at the end of the life of the bond. when it comes to stocks, at least in the dividend discount model, because this is one first model we study, I will discuss other models quickly afterwards, but the main model is the dividend discount model. So it's based on the fact that we assume that we will receive dividends every year, like coupons for the bonds. So we receive dividends, and then we will sell the stock after a certain number of years. So we firstly consider 1 year investment. So we calculate this. And so now we can move on to the next step of the theory behind that, which is about the Gordon-Shapiro model. The model that was developed in the 1930s, and the two researchers, they won the Nobel Prize for it. Because if you remember, I told about it during the first day, I said this guy made something new that was first time they were the first to consider that to calculate the price of a stock, we shouldn't rely on historical values, but future values. And so they thought about what could be the future cash flows, and they say, okay, dividends and selling the stock. So first step, they consider 1 year horizon to see how it works. And then they move to a several years horizon, so multi-year investor. So what would be then let's say the pattern of the cash flows, and how can we calculate P0 if we keep the stock for several years instead of 1 year? Well, actually, it's quite the same, right? We're gonna have the dividend the first year, and then the second year, we're going to have the second dividend. And then we sell the price of the stock P2. Okay. And so to recalculate P0, we do just a present value of this, which can turn into, as you can see, the constant annuity of the dividends and one unique cash flow with P, as we did for the bonds. But actually, the theory does not stop there, because they say that, okay, so 1 year, 2 years, okay, so each time we will consider dividends, and then the last year, the selling price of the stock. So we could extend that to n years, right? So this is the next step of their demonstration. And so this thing is known as a dividend discount model. Okay, so when we say that P0 is equal to the present value of all the dividends to come, and then the selling price of the stock at the year end. But finally, it's not even finished, because the next step would be to say, okay, what if we, it makes sense, right? You could create a company and you want to keep it forever, right? That could be something acceptable as an assumption. So that's the next step, to extend this. Okay, what about now if we never sell the share? So, well, it's going to be the dividend, the present value of the dividend during n years, but finally it's going to be during a forever time, right? So we could consider that finally the price of a stock could be calculated using a perpetuity formula, right? Because we consider that every year the company will pay some dividends. Of course, there is an assumption behind that, which is the fact that the company will pay dividends. Okay, so that's one pitfall of the model, because if the company does not pay dividend, we cannot use the model. But it's a little bit of a theoretical model. It was the first model that was developed in the time, so we developed this and then we moved to other ones. And so the last assumption Gordon and Shapiro added is to say, okay, we're going to consider that the value of the stock is the perpetuity of the dividends to receive. But then they said, okay, but maybe we can assume that the company will grow, right, throughout the time. So it's not a constant perpetuity they use, but a growing perpetuity. Okay, so this is what you have here. And we reach the final step of this model, which is to say that applying the dividend discount model, which is the first of the models, and a constant dividend growth, okay, G, forever, okay. So we can have this pattern for the timeline, okay. So P0 will be equal to the present value of dividend 1, dividend 2, which is dividend 1 times 1 plus G, and so on. Growing perpetuity. Nothing difficult in terms of calculation. So if you remember well the formula of the growing perpetuity, And this is why we spent so much time on time value of money, because we were really learning the models that we would use, and you will also use later in the MEBF for with other professors. So here, well, we can see that we're going to use the growing perpetuity formula to be able to calculate P0. Okay, so except that maybe we name them different. So it's not cash flow, it's dividend. Okay, it's not R, it's RE, the equity cost of capital, and G remains a growth. Okay, so according to this model, this is how we're going to calculate P0. P0 will be equal to dividend 1 divided by RE minus G. Okay. And another way to put it is that we can also calculate the cost of equity using this, right? As we did earlier for the dividend yield and capital gain rate. And we can see that when we redistribute this, right, RE minus G, you put it instead of P0, you could put P0 here, and then you put G on the other side. So you have the redistribution of the equality. And so you have the equity cost of capital, which is equal to what we just calculated yesterday before the end, okay, dividend yield. And now the capital gain rate is not there anymore, it's G, okay? So please keep that in mind for later, that we will make a link between the capital gain rate and the growth rate, okay? For the moment, I put that aside. It's not what I want to show, okay? So let's make a very quick example to apply this model. So you have a company, which is a regulated utility company, okay? So suppose they plan to pay 2.60 per share in dividend in the coming year. If the equity cost of capital is 6% and dividend are expected to grow at 2%, what would be the value of the stock? Okay, so I'll let you 2 minutes. That's your warm-up for today. You know, it's like when you do some sport, you need to do some warm-up before getting into serious stuff. So this is it. So this is our warm-up before we get into more serious stuff. And you can share, of course, the answer in the chat, as you do usually. It's very nice for me because I got some feedback. That's correct. So we got Kien already there. Zheng, Anne again, another two persons. So 65, yeah. So this one is not complicated, okay? You could say, okay, for this one, it's simple. Yes, but Chang is correct too. What you have to understand, of course, is what would be difficult or what would take your brain's energy would be what the researchers did in terms of theory, which is behind yes, Dong. So the applying the formula is not so difficult. What was difficult, of course, it was to imagine what could be the assumptions behind this model and so on. Okay, and that's nice because now we got a model to be able to calculate the price of the stock using the dividends to come. Okay, so we need just as it is said in the example just before. Yeah? So we just need assumption for the dividend, the current dividend level. Okay, the cost of equity. Okay, and the growth rate. So growth rate would be a sort of a macroeconomic indicator, I guess. Cost of equity would be different ways to think about the cost of equity, RE. The first way would be to say this is you as an investor, what you expect to receive in terms of return if you invest in this company. Okay, so that would be the first approach. And the second approach would be to maybe look at what is the normal cost of equity in an industry like this, in a country like this, to have a sort of a benchmark of existing cost of equity if you want to. And the last way to think about how you can calculate RE, cost of equity, would be actually something you will develop with my colleague Pramwan Bunkanawisha in financial structure and strategies, where you will use a model that I talked about already, such as the CAPM, the capital asset pricing model, where would you have again the idea of a risk-free rate plus a premium. But this premium would be a little bit higher than the premium we discussed for debt when we were talking about gap or whatever, because we were talking about the cost of debt. The cost of equity is usually higher than the cost of debt. Okay, so please keep that in mind as well. But sometimes the approach to find it is the same, and the only difference is that the risk premium will be higher when it's about the cost of equity than when it's about the cost of debt. Because the risk is higher the risk is higher not to get your money back when you invest as a shareholder in a company than when you are a bank or when a bondholder. Okay, usually mechanisms exist for you to be quite sure to have your money back when you have a bond. Okay, when you have a share, sometimes if the company bankrupt, you will have nothing back. So usually cost of equity is higher than cost of debt because it's more risky to be a shareholder than a debt holder. Okay, so we've seen the first step about the dividend discount model. Now let's play a little bit with it. Okay, especially about what the model of growth. Okay. Firstly, I would like to tell you that here we consider that we have growth, which is positive, which this is usually the assumptions we take, because all the economical models are developed with positive growth, okay? Knowing that, and maybe it works for Vietnam, for example, because in Vietnam there are still some growth, but when it comes to Europe, for example, or some other countries, maybe the assumption is not so good anymore because growth is not so much there. So it's interesting to see how the models are very sophisticated, but also not perfect. So we have to remain critical about them, but basically, for the moment, we keep on going, taking an assumption about positive growth. Okay, so now the idea is to say how we can expect to increase the dividend that you would receive from a company. This is what you have on the screen. Okay, a dividend of a year. We can see it's linked to 3 potential factors. Okay, so if you want to increase the level of your dividend, the first thing you can increase is the level of your earnings. Okay, so if your profit is getting bigger and bigger, theoretically, the dividend, if you pay out the same percentage, will be bigger. The second assumption you can make is that, okay, you don't increase the level of the profit, of the earnings. Earnings is like profit here. Huh? So you don't increase the level of your profit, but you decide to increase the percentage you pay out as dividend. Okay, so what we call the dividend payout rate is the percentage of the profit you will pay out as dividend. Okay, so just to be clear here, because maybe we will need that later. I prepared some stuff, so I will come back to this. So you got the earnings, okay? Then you got the payout rate, okay? That will be, let's say 30%, okay? And the rate, what you will have also is what will be the retention rate, okay? So let's say here it's 70%. So sorry, 70%. So what I mean is that what you do with the earnings is you have only 2 solutions, okay? So you pay out a part of the profit as a dividend. So you give the money, the cash to the shareholders, or you keep the money within the company, okay? And it goes in a place in the equity which is called retained earnings. So we retain our earnings, okay? And so this money, and so it means that this is cash which is not paid out to the shareholders. So this cash will be available for the company to invest in new projects in the future. So globally, the company has two things that she can do with the profit, or to pay out to the shareholders, okay, as dividends. So they give cash back to the shareholders, or they keep the money within the company for future projects, okay? And so do not forget that you got, in terms of vocabulary, payout rate, that is for the percentage of earnings paid as dividends, and retention rate, which is actually the percentage which is kept within the company, okay? So that was for vocabulary. So coming back to what we have here, so if we want to increase the dividend of 1 year, or we are able to increase the earnings, okay, or second solution, we increase the percentage of the payout rate, okay, and in that case we will have a higher dividend. Another factor that could influence this is the number of shares outstanding. But for the moment, we're gonna put that aside. We're gonna consider that the number of shares is remain constant. Okay, so we assume that the number of shares is constant. Okay, we will see later how it goes when it changes. So it means that we have only two possibilities to increase the dividend, or we increase the earning. Okay, so the net income, so the profit in your income statement, or you increase the dividend payout rate. And so this is what we're going to discuss. So this thing is interesting to get into together, because you will see that, you know, it helps us to understand what is behind that. What are the let's say the main consequences for the company. So again, the company can do two things with the earnings: pay out to the investors, payout rate, or retain them, and so they reinvest them, right, in some future project, as I said. Okay, so again, the change in earnings will be only linked to the money you invest in new projects. Okay, so that will be linked to the part of the earnings you retain. Okay, so we can say that the change in earnings, meaning the increase in earnings, will be equal to the amount you invest in new investments, new projects, time the return on the new investment. Okay, and the new investment in this model will be considered as the part of the earnings which is retained. Okay, so you have the earnings, so you have payout rate, so percentage which is paid out as dividend. The part which is not paid is retained. Okay, so you keep it. Okay, and so you have a sort of a new amount of money, which is retention rate times earnings, and this amount is supposed to be invested in a new investment, and this new investment will create a new return. Okay, and so this is how you will be able to create some wealth for your company. So this is the model. So that's interesting. So what we're going to discuss with a little example later on is, should we pay out dividend, or should we keep the money inside? Is in which situation is it better to do the first or the second one? So also what we can say is that, if you remember well, I told you earlier to remember that the growth would be here linked to the capital gain rate. Okay, so here we can say that the growth will be linked only to the part of the profit you retain. Okay, so I put that in the chat. Okay, G will be linked to the part of earnings retained and invested in new projects. Okay. Yeah, there is a mistake in the, but it's okay. Okay, so what we can say is that, and this is when I did something on Excel. So let me share with you to link the two slides. Okay, so in the first, so the change in earnings will be equal to new investments. This is what you have on the slide. Change in earnings, so increase in earnings, will be linked to the new investment times the return on your new investment. And the new investment is the level of earnings times the retention rate. Okay, and so if we just replace new investment here, you know, okay, so change in earnings, so we replace new investment here by earnings times retention rate. So we have change in earnings. So increase in earnings will be equal to earnings times retention rate times return on new investment. And then if you take back the earnings here, okay, the other side of the equality, so you got change in earnings divided by earnings will be equal to retention rate times the return on new investment. And change in earnings divided by earnings, so that's a percentage, and this percentage is the growth. Okay, so growth would be equal finally to retention rate. Yes, you're supposed to see the Excel file. Sorry, I didn't share it. Okay, so I'm going to take it again. Okay, sorry. So this is, so this is from your PDF document. Okay, so in your PDF document, you got this. Change in earnings will be equal to new investment times return on new investment. Okay, and also in your PDF, you can see new investment is equal to earnings times the retention rate. So what you don't have in the Excel file is these two lines here. Okay, so it's not complicated. It's just that I want it to be clear. So when we take this line, new investment is equal to earnings times retention rate, and you put that in the first equality. Okay, so the first equality become change in earnings is equal to earning time retention rate time return on new investment. Okay, and so what I was saying, and sorry you could not see, now you can see. So when you take earnings here and you put it the other side of the equality, you got change in earnings divided by earnings is equal to retention rate times return on new investment. Okay, it's just a redistribution. And so finally, what does it mean? It means that change in earnings divided by earnings, okay, it's a percentage, right? A percentage of growth. So this is our growth rate. And so our growth rate, as it is said, as it is said in the, you can see it now, because I see you say we cannot see the file, but is it like, is it, could you see it now or? Okay, sorry. So the remark was a few seconds ago. Okay, so you can see it now. And so just to explain that, yeah, so why we have the growth rate, which is equal to retention rate time return on new investment. So I come back to the slide. So this is what we have here, right? So I was just making the link between these two things so you can follow, okay? So what does it mean at the end of the day? Listen to me carefully. G is equal to retention rate time return on new investment. So if you do not retain any money, so if you pay out 100% of your profit as dividends, you will not have growth. Okay, this is what it means. Because growth is linked to the part of the earnings you keep in the company for future projects. So it's logical, right? If you make profit, if your company makes some profit, but you give all the profit back to the shareholders, the cash will be in the pocket of the shareholders. So the company will not have this money available to invest in new projects. So the company will not be able to grow. Okay, so this model is quite interesting because it says, should we pay back dividends to the shareholders or should we keep the money inside for new projects? Okay, so when do we do this? Okay, because of course, sometimes you have shareholders that put some pressure to have some dividends, right? So it's not so easy. A lot of companies will pay a part of their profit in dividends every year. There are a lot of theories about this, okay? Because it sends a signal to the market If you pay dividends, it means that your company is, you know, is in good shape, for example. Which is psychological, because it's not always optimal to do so. So let's apply that to an example, okay? Using this exercise. So I'm going to help you a little bit and let you do it by yourself afterwards. It's an interesting example. So you've got this company, Crane Sporting Goods. Let me take some coffee. So Crane Sporting Goods expects to have earning per share $6 in the coming year. Rather than reinvest these earnings and grow, the firm plans to pay out all of its earnings as a dividend. With this expectation of no growth, Crane's current share capital is $60. So let me add something in the chat to help you. Using the info of the first paragraph, calculate RE, the cost of equity. And then suppose Crane could cut its dividend payout rate to 75% for the foreseeable future and use the retained earnings to open new stores. The return on the investment for these new stores is expected to be 12%, assuming the cost of capital is unchanged. What effect would it be, would this new policy have on the stock price? So using the second paragraph, okay, you can, using the second paragraph, calculate P0. Okay. Okay, sorry, there was a mistake. Sorry, so there's a, sorry. So using the first paragraph, calculate RE. Okay. So using the first paragraph, calculate RE, and using the second paragraph, calculate P0. Okay, so I'll let you a few minutes to do it, and we discuss the solution together. Yes. Okay, so I think we have some good answers now. I can see so many good answers. So I think it's time to share the solution. Sorry, I just share the official solution. I don't write down something, but I think we can get the information from here. So firstly, I said to you, I guided you a little bit, saying that you so sorry. Okay. So yeah. So what I said, the first paragraph is to calculate the cost of equity because we suppose that it will not change, which is a reasonable assumption. So of course, what you have to understand there is to say that it is said that the company will so the company will pay out, plans to pay out all of its earnings. So the payout rate is 100%. So in that case, gross is supposed to be 0. Okay, so this one was the one you needed to understand. And so if we know that G is equal to 0, we can use, this formula I was just trying to link with this example just before. Cost of equity is equal to then dividend yield divided by P0 plus G, okay? And since we have a dividend of $6 for a P0 of $60, so it means 10%, okay? So then we find that the cost of equity is 10%. So that now that we have it, we can use it. We can use it to be able to calculate things. So I see a lot of answers with 4 figures after the dot. So maybe it's linked to my advice to keep 4 figures after the dot for the monthly rate for the loans. I think here, when it comes to, value of shares or whatever, we can keep only 2 figures after the dot because we are talking about economical value. So it's like dollar and cents. So the only moment I think we need to keep 4 figures is when we calculate monthly rate for the loans. For the rest, we can round to 2 figures after the dot. Huh? Do not keep too much figures in this situation. Okay, so yes, we have 10% for the return on equity. Okay, and so then it said now that. Okay, now we change the strategy. We pay out only 75%, okay? And so that means, as I said earlier, I took the time to tell you that if it's not payout rate, it is retention rate, right? So if we pay out 75%, it means that the complement is 25% for the retainer for the retention rate. Okay, so we have a retention rate of 25%, which we can find here, and this percentage will be used to calculate G when we do retention rate times the return on new investment. Okay, so what we do here, we say that 25% of our profit will be invested in investments that earn 12%. Okay, so that should help the company grow by 3%. So G will be equal to 3%. Okay, so now we have the assumptions for G, the growth, 3%, which is linked to retention rate, return on new investment. And so we can use the growing perpetuity formula to calculate P0. Be careful, of course, sometimes students forget to change the level of dividends because now the dividend is not $6 anymore. It's $6 times 75 because we pay out only 75. So usually there are some mistakes here. People do forget to change, okay? So if we pay out 75% instead of 100, so it changes the level of the dividend 1, and of course, it changes the growth rate, which is now different from 0. And so we find 64.29 for the price of the share, okay? So it looks like it would be a good thing, right, for the company to do so, because to retain a part of the earnings and to invest in these new projects, because the price of the share will grow from 60 to 64.29. Okay, so there is an increase in the price of the share. Why is it so? Well, it's because simply the return on the new investment, 12%, is higher than the cost of capital, 10%. So it means that the new project earn more than the average project of the company. Okay? Another way to put it is that the return on new investment that we discussed, the 12%, is actually the internal rate of return of this project. Okay? And the equity cost of capital would be here considered as the discount rate. And in this model, we assume that there is no debt, okay? So we don't consider cost of debt. So what it means that when you have money in this company, on the one side of the mirror, the investor, we consider there is no debt. So the investor, they expect to receive 10% on their project. So this is why we have this cost of equity, okay? And on the other hand, so we get assets that earn 10%, okay? So we get assets that earn 10%, 10%, 10%, so we give back 10% to the shareholders. And then we have this new project, okay? And this new project has 12% return, okay? So we have a lot of assets already. On the average, they earn 10%, so we give back to the shareholders. So here we have a new project, and this new project that we will put among the other assets of the company is earning 12% instead of 10%. Okay, so of course we add to our assets something that will create some wealth for the company, right? And so of course it's a good opportunity for the company. So it's a project with a positive NPV. This is what we could say also, okay? Positive NPV. Okay, do you have any question about this example? Okay, no. So we can go on with the next question. Same exercise. Just, okay, we just change an assumption. I'm sure you will understand what we do very quickly. So suppose the company decides to cut its dividend payout to 75%. Okay, so the same thing, right? Same thing. So, but now what is changing is that the return on the new investment, instead of 12%, it's 8%. Okay, so given all the rest is the same assumption. Now, what is P0? Okay, so P0 if return on a new investment is 8% instead of 12%. Okay. So what would be the new P0 here? So Trong tries 56.25. I think this is correct. Yes, this is correct, Trong. Bravo. And Kian find the same thing. Huyen find the same thing as well. Okay, so I let 1 or 2 more minutes for other people to have the time to check that they find 56.25 as well. So Hong found that too, Zhang found that too, Anne found the same thing. So I think we can share the solution. So I'm gonna put it in the chat, but I said to myself, maybe I should, instead of writing in the chat, I should write on the Excel so we can see that in the video and so on. So for the next example, I will use Excel. Anyway, this example is not so complicated. So the only thing that is changing is that the growth rate now, right? Growth rate is now 25% times 8%. Okay, instead of 25% times 12. So we get 2% of growth rate instead of 3. Yes, John, this is correct. And so we can see that P0 now it's 56.25. Okay, so 56.25 is of course lower than 60. Okay, and earlier 64.29, right? Yes, 64.29 is, of course, higher than 60. So compared to the beginning situation, this time, the price of the share has been going down, okay? It was 60, now it's 56.25. So according to our actions, that would mean that it's not a good idea in that case to invest in a new project, okay? Because the price of the share is going down. So why the price of the share is going down? Because return on new investment is 8%, okay? So it's lower than the cost of equity, 10%. So the NPV of the project is negative. Again, I take the same image that I did before. You have in this company assets that on the whole earn 10%, okay, on the average. And then suddenly you add this new asset that earns only 8%. So it's less efficient than the other assets, right? So it's going to decrease the value of the company. It does not create value. It does not create value. Why? Because 8% is lower than 10%. So the return on the new investment is lower than the minimum return expected for the company, which is 10%. Another way to put it is that this project has a negative NPV. Okay, so this is always what you should consider. And so I come back to a slide which is just before the example we made, that is supposed to introduce the example, but I usually keep it for as a conclusion, because I think now we understand better what it means. So the question in this model of growth is to say, as a company, what do we do with the earnings? Should we give this money, these earnings, as dividends to the shareholders, or should we keep that for us as a company in retained earnings so we can invest in new projects? Well, it depends actually on the profitability of the firm investment. So it depends if it's 12% or 8%, okay? So cutting the firm's dividends to increase investment will raise the stock price if and only if the investments have a positive NPV, okay? So this is the case in our first scenario. We have return on investment of 12%. 12% is higher than the cost of equity, 10%, okay? So it's a positive NPV project, okay? So the price of the share is going up, 64.29 instead of 60. Second example, 8% return on investment new projects is lower than 10%. So what is happening for the stock price? It's going down, okay? So globally in this example, the company should decide that if they find projects that earn 12%, it's better to keep the money inside the company and invest in the new projects. On the contrary, if the company does not have good projects to invest in, it's better to give the money back to the shareholders with dividends. So maybe the shareholders, they have the cash in their pockets so they can invest somewhere else at 10% or maybe find another opportunity at 12%. Okay, so this is this model of growth. What it is saying. Do you have any question in the chat for me about this, or is it okay? Is there different in payout dividend by cash or stock? So it's not part of our course. It's part of what we call the payout policy. So the payout policy, you will study that in financial structure and strategies. Okay. You can find the information in, I think this is a chapter 17 of the book, Berg de Marzo, if you want to know more. But if you want me to summarize in a few seconds, the theory, it says that it is the same to pay dividend by cash or by stock. It's supposed to have no influence on the value of the stock. So normally in a perfect world, it is equivalent to pay out dividend by cash or by shares. Okay. What will be changing is if we are talking about the real world instead of the perfect world, the frictions will come from tax issues. So maybe dividend will be less expensive than buying backs, or the other way around, or maybe dividends will be more expensive because you have to pay taxes right away when you receive dividends. And when it's stocks, or when it's buying back stocks, it means that you do not receive stocks, but there are less number of stocks outstanding. So it means that your stock has a higher value, but you didn't receive the cash for it. This is a potential capital gain, which is higher. And so you don't pay taxes right away. So in a perfect world, it's equivalent. In the real world, the difference will come mainly from the tax treatment of it. And you will rediscuss that with Pramod. Is that okay? Yeah, okay. Okay, so this one we did, okay. Okay, now let's discuss something also interesting. As I said, the model we are using is based on the fact that we consider that the company will pay dividend, okay? The problem is sometimes the company does not pay dividends. So how can we do? Well, it depends on the situation, but for example, we can sometimes find a solution for this. And this is what we're gonna discuss now, okay? So we cannot use the constant dividend growth model to value a stock if the growth rate is not constant. For example, young firms often have a very high initial earning growth rates. During this period of high growth, these firms often retain 100% of their earnings to exploit profitable opportunities. As they mature, the growth is going down, and so it's stabilized to a certain point, and they begin to pay dividends. Okay, so what we are saying here is that for these young firms, during the first year, the payout rate will be 0, and so the growth rate will be high, and then after 4 or 5 years, the payout rate will be different from 0. They will pay dividends, and so the growth rate will go down. So how can we do to calculate the value of the stock? So we cannot use the model directly, okay? But finally, it's like we can use the model, but later in time, okay? So this is what we have here, okay? So when we have change in growth rates, for example, we can consider that in that case, dividend 1 to dividend n, okay? Dividend 1 is 0, okay? Dividend n is 0, okay? Because during the first years, they will not pay dividends, okay? So we will consider that dividend 1 will be equal to 0, dividend 2 will be equal to 0, dividend n will be equal to 0. And then say that suddenly, for the first time, dividend n plus 1 will be different from 0. Okay? So in that case, what we can do is to calculate P0 by saying that dividend 1 is equal to 0, dividend 2 is equal to 0, dividend n is equal to 0. But then from dividend n plus 1 to the infinite, we have a growing perpetuity, okay, that we calculate in the year n. Okay, so dividend, growing dividend paid from n plus 1 to infinite, okay? So we get two steps. First, we calculate the growing perpetuity in year n, okay? And secondly, we discount this growing perpetuity to year 0. Okay, so what does it mean? It means that only here we're going to have dividends which are different from 0, okay? And we consider a growing perpetuity. So the first time we have a dividend which is paid, it's n plus 1, and then it's going to grow by 1 plus g, okay? So we can calculate the growing perpetuity in year n. And once we have it, we can just have to bring it back to the year 0 to calculate P0. So we calculate firstly Pn, and then we calculate P0, okay? So in the first step, we calculate Pn, and in the second step, we calculate P0, okay? So we have an example about this. I'm gonna let you work on this for a few minutes. So we got this company, Small Fry Incorporated, that has just invented a potato chip that looks and tastes like a French fry, okay, whatever. Given the phenomenal market response to this product, Small Fry is reinvesting all of its earnings to expand its operations. So, you know, at the beginning, the retention rate is 100%, payout rate is 0%. So earning per share this past year, okay? So you remember we had this trouble in the calculation in an example we did in the time value of money. So this earning per share this past year is just to help you to know what is the earning per share today, so you can calculate EPS 1, earning per share in year 1. And I expect it to grow at a rate of 20% per year until the end of year 4. At that point, other companies are likely to bring out competing products. Analysts project that at the end of year 4, Small Fry will cut investments and begin to pay dividends 60%, and the growth will slow down at a long run rate of 4%. So if the cost of equity is 8%, calculate the value of the share today. Okay, so you just firstly you apply this model. Okay, I invite you to really draw on a timeline, date 1, 2, 3, 4. What is you know, the earning per share, the growth rate, what is the dividend, and so afterwards you can, you know, you can calculate the value of the share. So okay, I'll let you a few minutes to do it. It's a little bit more complicated than the previous example, so I'll let you 10 minutes to do it maybe, and we'll look at the solution together. Of course, if you have an answer, you can share in the chat. Okay, so at least I know that some of you guys finished. So do you have any question firstly, or do you see what you have to do? Okay, so I'll let you try to do it 10 minutes, then we discuss the solution together. It's a good training as well, this one. So no, Dong, it's more than 30. Kien, it's okay. If you want, Dong, you can share a private message with me if you want to show me the detail of your calculation so I can look what you did. If you're not comfortable sharing with everyone, you can just share with me. I can see, maybe understand. That's correct, Hung. Yeah, that's correct, Hung. Okay, put my camera back. I'm still there with you, of course. It's just that sometimes I don't know. Do not hesitate to share the answer with me in the chat. It's more for me to see how many people finished the exercise, because I want to find a good rhythm, the good pace, right? A good rhythm. Because okay, some people finish and they found the right answer, but some other are certainly keep still trying. So I don't want to be too quick on sharing the solution, so people have time to try. So thank you, Liam. So that's correct. I wait. I wait a few more minutes so people so more people can share the answer, and 2 or 3 minutes, 2 or 3 minutes more. So Dong, I made mistake for the last question. 62. Okay. Okay. So Dong, if you have 62.25, it's okay. I mean, that was the most important. So and finally, if you are able to know where you did a mistake, it means that you understood, right? So that's I'm happy for you. Yes, I find the same thing than you, Chang. So people find 49.42, but with Excel, I find, for like you, 49.38. So that's correct. And that would be, of course, correct if you say that to the exam, right? Okay, 1 more minute and I share the solution. Yes, that's correct, Chang. Thank you for sharing. It's very useful for me to have some feedback. By the way, am I sharing my Excel just right now? It seems so, right? Or not? I don't know. Okay, so this is it now, but that now it's made up on purpose. Okay, sometimes I don't share my Excel when I should, and sometimes I share my Excel when I don't want. Anyway, that's life. We are not perfect, right? Okay, so please have a look at, so I'm gonna discuss a solution now. So maybe please have a look at the, I cannot, so me, it's correct. So 62.25, it's correct. Now it's P3, so you just have to discount it today to find P0. So yeah, so keep an eye on the PDF document where you have the data, because I cannot see the data at the same time. Maybe I can share that in my other screen. Okay, I'm gonna put it here so I can read it at least, but I cannot show it. So you should see my Excel right now, right? You should see my Excel. If it's not my Excel that you see, please, we can't see your screen. I can't see your screen. Okay, so let's share it again. Is that correct now? Okay, super. So, okay, so you have the Excel. Okay, so I'm reading the PDF at the same time. Okay, so earning per share is $2 now. Okay, so like we had this problem in one example, so it's just the data, so we can calculate these ones, but finally we don't use it, right? It's a thing from the past, and this is maybe even the way it's said in the case. Earning were $2 per share this past year. Okay, so it's like, you know, what we have to understand from that is that it's an information from the past, so we should not take that into account in our calculation in terms of cash flows. But of course, we have this is how we calculate the earning per share in year one. So just to be clear with everyone, earning per share is earnings of the company, okay, divided by the number of shares, okay? Just to be clear. So in year one, so we have, so I put the G rate, the growth rate here. So year one, 20%, 20%, 20%, 20%. And so they say, analysts project that at the end of year four, small fry will cut investment and begin to pay 60% as dividends, and that will grow at 4% then, okay? So this information here, it's at the end of year four, okay? So that's important to understand. This is why 4% is only year five, because this is next year, okay? But we begin to pay out this year in year four, okay? Because maybe I didn't insist on this, but usually in finance like this, the cash flows like the 2.49 are supposed to happen on the last day of the year. So date 4 is actually 31st of December, okay? Okay, so we consider usually that the cash flows occur the last day of the period, which is theoretical because, of course, in real life, your company will sell every day, right? But since the discount rates we are using are yearly rates. And since here we are talking about the dividend, so we can accept that the dividend is paid only once a year. Okay, so that's correct. So okay, so the growth rate is 20% during four years. So the EPS go from 2 to 40 to 4.15. Okay, but we don't care anyway because the 3 first years, as we can see here in blue, the discount, the payout rate, sorry, is 0. Okay, we only begin to pay in year 4. So what does it mean? It means that there is no cash flow, right? Here, year 1, 2, 3, like I was explaining in the PDF, okay? Dividend 1, 2, 3, there is nothing. The first dividend we receive is in year 4, okay? So that's dividend 4. That's the first dividend to be paid, okay? That will grow as a perpetuity at G equal 4%, okay? Okay. So that's why the first time I got a cash flow is in year 4, okay? So the value of the share that I will calculate would be 1 year earlier, because we always calculate P0 with dividend 1, so there is always 1 year of time lag. So if we have the first dividend in year 4, it means that the P we're gonna calculate is P3, and it's gonna be equal to dividend 4, equal to dividend 4 divided by R minus G, okay? So 2.49 divided by 8% discount rate minus the growth rate, okay? So what does it mean? It means that P3, the value of the share in year 3 is 62.21. But this is not what we want. So here, according to what I wrote down in the chat, we just finished the first step. Okay, we calculated P3. But now we have to bring back this 62.21 to the year 0. Okay, so it's just discounting over 3 years. Okay. By the way, I shared what was in the chat from your colleague Kian, because I find that he says a lot in only a few sentences, so it's in terms of calculation, it's quite okay. And me, I show you the version like with the graph and everything, so you have both. And so P0, okay, so the final answer that we are searching for is P3 divided by 1 plus 8% exponential, okay? So we have a little difference because some of you guys, you find 49.42. I think this is what they say also in the slides. So I think when you do it with a calculator, you find this. And when you do it with a Excel, maybe you do this because of rounding issues, I guess. And so we finished. We finished with this thing. So we really applied what we wanted to apply, which is for startups, we cannot use directly the dividend discount model because they don't pay dividend in year 1, 2, 3, but we can use it later on and then just discount the cash flow, discount the value we find at the date 0 to calculate the value of the share. Okay. So this is it for this example. Do you have any question for me in the chat? About the calculation, about something else? So what we do here is we calculate the price of the share. Okay, it's clear. Thank you, Me. So you could put yourself in the shoes of this person in this example. You could say, you know, valuation of a share it's very useful if you want to, you know, invest in a company. Okay, so maybe this is what we do here. You would like to invest in a startup. Okay, so maybe there are some young people that comes to see you, and and they say, okay, we got this company, you know, it's very innovative process about manufacturing fries and everything. And but we need a partner today to invest in the company because we, you know, we need some, you know, some extra cash to be able to, you know, invest in R&D and everything. So would you like to join this company? And so this is when you do this calculation, you say, okay, so according to my calculations, this is a good project. Okay, so I will say to the young people, okay, I agree to invest in your company, but you have to promise that we don't pay dividends during 3 or 4 years, okay? Because we need to invest first and then blah, blah, blah. And so according to my calculations, the price of the share is 49. So I will buy, let's say 30% of the shares of this company, or we're going to issue new shares of this company. And so we agree by in the contract that I will pay for this share 49.38 times the number of shares. Okay. And so people agree on this. And so of course, this is what you do every time when you do a valuation of shares, when you, in the context, for example, of a company that you want to put on the stock market for the first time, you need to do this, right? To be able to calculate the value of the share. Or if you are talking about a company which is not a listed company, a public company listed, I don't know, any business, you know, in Vietnam, you know, like family businesses, manufacture, you know, industries, you know, 50, 10 to 50 employees. Yeah, this is how they would calculate the value of the share, maybe with some other models, but still this is, the process is this way, right? I really like this topic, valuation of shares. I've been doing a lot of this with my students here in Canada. The equivalent to you guys, but they are preparing the CPA exam. So I teach them the finance aspect for the CPA exam. And so there's a lot of valuation. And in Canada, there are not so many companies which are listed. So it's a lot of, unlisted companies as well. So we need some methods like this. So we have, of course, more sophisticated methods. And I think you have a course which is dedicated to this with Professor Alain Chevalier, which is a company valuation, I think. So that's why we call it basic valuation in our course here, because, it's like a first step for you to understand the main principles. And of course, we will see a few methods after the break, but globally, you will get into more details with Alain Chevalier, where you have a dedicated course about company valuation. And frankly, this is a topic really exciting, I think. Depends, of what you want to do, but I like this topic. But anyway, if it's clear and if you have been able to, to check about your results, it's 8:25 p.m. for you guys. So you deserve a break now, maybe for dinner or just to have a tea or something. And so as usual, I propose that we do a 20 minutes break. So for you guys who eat, so you have time to eat. And so it's 8:25. So let's meet again at 8:45 for the next, for the second part of this course. Okay? So see you later. Yeah, thank you to you too. Bon appétit. Okay, everyone. So it's time to come back for the second part of the class today. My tea is too hot, so I'm gonna wait a little bit to drink it. Just can somebody confirm that you can hear me and see me? Okay, thank you, me. So so let me share. Thank you, Mai. Thank you, Kian. Okay, let's come back to. Can you see it? The PDF document. I'm gonna do the same way than I do as usual. So, sorry. Okay, so you should see it now. So far we've been talking about stock valuation, and we've been talking about the dividend discount model. Okay, dividend discount model meaning we calculating the price of a share using the dividends we expect to receive in the future, discounted today. So this model is interesting because it gives us at least one first way to calculate the price of a share. But of course, it's not a perfect model. So as I said earlier, it's a model which is quite old, and it's a model which is quite old and that has been, reviewed and improved and, rediscussed since, but still it's a good first approach. Okay, again, you will see later on during the MEBF some of the models with Professor Chevalier. So what are the limitations of the dividend discount model? Well, firstly, there's a lot of uncertainty, right? Especially in the dividend growth rate and the level of the future dividends, okay? Especially if we think about the COVID time, right? What is the level of growth rate now compared to what it was 1 year ago? That's a good question. So of course there is an uncertainty about that, and there is also uncertainty about future dividends because we assume that the company will generate some profit, but we are not certain of this. Okay, so we are basing our calculations on assumptions which are quite uncertain. And also one thing which is interesting is that if you do one small change in the growth rate for the dividend, it's going to lead to very large change in the price. Okay, so it's very sensitive. So it's good that we have this method. It's not perfect, but at least we have one. And we also try not to forget that we have these limitations. So, of course, as I said, other models have been developed. So I'm going to quickly introduce them to you guys. So the second model is what we call the total payout model. And the third model is the free cash flow valuation model, which is also called the DCF, discounted cash flow model. Okay, but that's free cash flow valuation. Okay, so for the moment, let's focus on total payout. Okay, so total payout, what does it mean? It means in this model, so the total payout model that we discuss now is an evolution of the dividend discount model. But it takes into account the fact that, sorry, I'm going to put my, because I hear my wife, she has a conference in the other room, so. Okay, so in the total payout model, instead of taking into account only dividend, we're going to take into account dividends and repurchases of shares. So finally, we're going to discuss that a little bit because I answered to a question earlier. I'm not going to get into the details, but we see. So for share repurchase, what are we calling share repurchases? So the share repurchase is when the firm
use excess of cash to buy back its own stock. Okay, so it means that the company will okay, let's consider that we have a company and the company has some excess cash. Okay, and so they want to reward the shareholders. So they have two ways to do so. The first is to pay dividend, and the second is to buy back some shares of the company on the market. Okay, so the company will buy back on the market some of its own shares. Okay, so what will be the consequence of this? Well, it will be the fact that you will have less outstanding shares of the company on the market. Okay, so when the end of the year arrives, you have the profit, which is divided by a lower number of shares. So each of these remaining shares will receive a larger part of the earnings. So it's another way, right, to reward the shareholders. Okay. So I will not go in the payout policy, but I will go in valuation. So I will finally answer a little bit more to the question that was asked earlier. So we will see that it's indifferent. So the fact that you receive directly a dividend or the fact that the company buy back its own shares, it's two different ways for you as a shareholder to receive something. On the first hand, with the dividend, you receive directly the cash. On the second side, when there are share repurchase, you don't receive the cash, but the value of your share is increasing. So it's an indirect way to be rewarded. So on a valuation point of view, it will be considered the same to have received dividends or share repurchases. Okay, so in the context of if you have, so that's why we say total payout. Okay, so total payout is dividends plus share repurchases. Okay, both will be considered as money rewarded to the shareholder, to the shareholders, directly or indirectly. Directly, sorry, not director. Directly, directly or indirectly. Okay, so in that case, maybe I'm gonna share an Excel file to do it with you. So in the case of share repurchases, okay, so what we will do is we will so calculate. So if we make a link with the PDF, okay, so for the total payout, what are the steps? First step is to calculate the part of the earnings which is paid out totally. So that is dividend plus repurchases. Okay, repurchases. Okay, so that's calculate the part of the earnings which is paid out, the total of it. Okay, second thing is calculate the present value of this total payout using a growing perpetuity formula. Okay, that's the first. That's the second step. So it is like what we do in, so sorry, it's the same formula than for the dividend discount model, except that in the dividend discount model, we calculate earning per share and directly the value of one share. Okay. In the total payout model, we calculate earning per share for all shares, and we calculate firstly the value of equity, and only as a last step, we take total value of equity divided by number of shares. Okay, so this is what we do. So this is what you're going to do in the example. Okay, so in the total payout model, firstly, you calculate the total amount which is paid out, dividend per repurchase. So that is a percentage of the earnings which is paid out. Okay. Then you calculate the present value of this total payout using a growing perpetuity formula. So the percentage of earnings paid out, okay, divided by R minus G. Maybe I can put something like this, okay? Okay, so we have the same approach at what we did earlier, except that we do it for the total amount of shares, for the total amount of equity. Why do we do this? It's because we have something that is not existing anymore, which is the fact that we have the number of stocks, the number of shares, which is not constant anymore. If you remember what we said earlier this morning, voila, here on this slide, you can see, so it's for me, it's slide number 15, simple model of growth. So what we did, we said, assuming the number of shares outstanding is constant. Okay, so because we consider that the number of shares is constant, we can directly calculate the value of one share. Okay, because the number of shares is constant. Now we have this new problem, which is that in this new method, we have some shares which are repurchased. Okay, so the number of shares is not constant anymore. Okay, so we have to be careful. And so instead of calculating the value of one share directly, we calculate firstly the value of the total equity, and only at the end, we divide by the number of shares outstanding at the date 0. Okay, so firstly, what we will have to do is to calculate the present value of the future total dividend and repurchases. And then as a last step, we divide by the number of shares outstanding. So this block here, okay, that I try to, okay, the PV of future total dividends and repurchases, okay, is actually what I detail in the Excel, okay? What I detail in the Excel. So this is how you calculate. So you calculate the part of the earnings which is totally paid out. So dividend per repurchase, so which is a percentage of the earning which is paid out. Okay. Then you calculate the present value of this total payout using the growing perpetuity formula. Okay. So percentage of earnings paid out divided by R minus G. So what we are calculating here is the market value of equity. Okay. And not, okay, not one share, but all the shares. So it's the same approach that in the dividend discount model, except that in the dividend discount model, we use the earning per share and directly calculate the value of one share. When in the total payout model, we calculate the earnings for all shares, okay? So not EPS for all shares, but earning for all shares. And we calculate firstly the value of equity. And so as a last step, we calculate the total value of equity divided by the number of shares outstanding. And so we find the P0. Okay, do you have any question about this before we get into one example? Maybe the best way to check if you have understood it is to move to the example. So you should see my PDF document now. If it's not the case, please tell me. And so you get this problem called Titan Industries. So Titan Industries has 217 million shares outstanding and expects earnings at the end of this year to be 160 million. Titan plans to pay out 50% of its earning in total, paying 30% as a dividend and using 20% to repurchase shares. Remember what I told you earlier, to answer the question of one of you guys, it's equivalent for the shareholder to receive directly the cash through the dividend or to have share repurchase. If Titan earnings expected to grow by 7.5% per year and these payout rates remain constant, determine Titan's shares price, assuming an equity cost of capital of 10%. Okay, so you have the PDF, but you don't have the Excel I just wrote down. So please do this example and let me share with you again the method that I just detailed in the Excel file. So try to find the price of Titan's industry share today. I'll let you 5 to 10 minutes to do that, and we discuss the results afterwards. Globally, it's not easy to explain, but it's easy to calculate. So hopefully, once you do the calculation, it's more clear for you. So do not hesitate to share one result in the chat when you have one, so I know that you understood. I think so, yes. I think, yes, this is correct, Trang. Bravo. It is 79.26. You're the best from this for this example. You represent Hanoi very proudly. Yes, it's 79.26. So for the other ones, you know what to reach, 79.26. This is the answer you should find. As usual, Kian is sharing the details of the calculation, and that's correct as well. So, so you can use that always also. And Ha is finding doing everything in one calculation, but finding the right answer also. So that's correct. So for me, you have already the first step. Yes, the present value of, let's say the market value of equity is 17.2 billion. So that's the entire market value of the company. And then you just have to divide by the number of shares. Exactly. You divide by 217 million shares, which is the number of shares that we have today, right? And so you can find 79.26. Again, you will study more details of the payout policy, and you will demonstrate why is it equivalent to have repurchases and dividends. And that will be in the course Financial Structure and Strategies. And so that's chapter 17 of the book, Berg de Marceau. So that's Pramwan Bunkanawisha is going to tell you about this. But finally, I forgot that finally I introduced the topic already with this example, the total payout model. So we have already a first approach. Yes, Dong, this is correct. Congratulations also. Let's say 1 more minute and I discuss the solution. As you can see, I am well organized now to work from home. I got my teapot, I got my desk, I got my 2 screens and everything, which is actually, I don't have the choice because now it's been since March that we work from home. So we have to get comfortable, right? I'm really looking forward to the moment when I will be able to teach again to the students face-to-face. But we will have to wait another few months, I guess, for this. Let's consider that we are lucky that technologies nowadays enable us to at least communicate with the internet. Yes, Huyen. Yes, Zhang. That's yes here. So I begin to have more answers now. Ha also. So that is correct. So I think it's time for me to share the solution with you. So I keep my Excel and I have on my other screen the PDF of the example. So you can follow because you have this one. So, okay. So the earnings of this company is 160 million, okay? And they plan to pay out 50% of the earnings, 30% as a dividend and 20% as a repurchase of shares. So the payout is 50% of the earnings, okay? So that's 860 times 50%. And that's million of dollars. Okay, so it's time for me to say, as you can see, that I don't care that there is a percentage in dividend and percentage in repurchase, because as I answered to your colleague before the break, it's equivalent for us as a shareholder. In a perfect world, again, what's going to change is the tax issues and stuff like that. But usually what we do together in this fundamentals of finance, we consider what we call a perfect market situation. So we assume that there are no frictions such as taxes. That will come later, okay? So for the moment, we can consider that we receive 430 million out of these earnings, partly through dividends and partly through repurchase of shares, meaning we don't receive the cash, but the value of the share will increase because there will be less shares available on the market. So we get the payout. R is 10%. G is 7.5%. It's convenient. It's lower than the R, right? So convenient to make the example. And so now we can calculate P0. Okay, let's say firstly the market value of equity. Market value of equity, that will be payout divided by R minus G. Okay, so that's 430 million. Okay, divided by R minus G. So that's million. 17.2 billion, $17,200 million. So that's the market value of equity, huh? Market value of equity. According to the definitions, it's also what we call the market capitalization. Capitalization of the company. Okay. So if this company is listed, well, the market cap of this company will be 17.2 billion, sorry. Okay, so that's the market value of equity. So again, with this method, as you understand, we go firstly to calculate the total value of equity, and only as the last step, we divide by the number of shares. In the previous method, we were directly go for one share calculation because the number of shares was assumed to be constant. And so now, as a last step, we can calculate P0, which is 17.2 billion divided by the number of shares outstanding, which is in million as well. So I don't have to care about this. And so we find 79.26, sorry, I'm thinking at the same time. So just for the people would like the detail of calculation. Okay, so it's the market value of the equity divided by the number of shares outstanding. Okay, so P0 79.26. Any question about this one? I see many good answers in the chat. So I don't have enough experience about the online teaching with you guys to see if it's okay, but I know that we are in the top of the list when we have like 10 good answers. So I hope that the people who do not communicate with the chat understand as well. If not, please tell me. But I understand that some of you guys understand, do the calculations on your own, and prefer to not to interact on the chat and stay focused on the learning process. It's okay with me, of course. It's just that if you don't understand, do not hesitate to ask a question. So I see that I don't have any question here. As I said, this method is not complicated in terms of calculation, okay? It's just to understand, which is maybe more complicated. So the takeaway of this is really to say that the dividend discount model we calculate directly with the earning per share, the value of one stock, one share. In this method, we firstly calculate the market value of equity and using the same approach with a growing perpetuity, and only when we have this, we divide by the number of shares. And in the payout, we have the repurchases along with the dividends. Okay, so maybe you understood already, but this method is more modern, more recent, because it had to be developed, I think, I don't know exactly about the theory, but let's say that's certainly around the 1970s, because this is a moment when repurchases of shares became more common. It's very, very popular now, but not in 1 century ago, but for 50 years now, there have been a lot of repurchases. So we had to find a method. So this method we just discussed is actually just a modern version of the previous one, which takes into account the fact that repurchases are now possible. Okay, so that was for the total payout. Okay, so now let's discuss about the free cash flow valuation model, what we call also the discounted cash flow model. I'm just going to introduce this because this one you will see in more details with Professor Chevalier when you talk about company valuation. So in this method, discounted cash flow model, okay, it's an indirect method. Okay, it's an indirect method. You calculate the market value of the asset of the company. Okay. Then you deduce net debt to calculate equity. Okay. So what you do here is what to call, so the market value of the asset is also market value of the assets is also what we call the enterprise value. Enterprise value. Okay, so enterprise value here we can see is the market value of the asset. So these are the assets we're gonna determine at the market value. Okay, and once we have that, we deduce the net debt, which is debt minus cash, to calculate the value of the company. I think I prepared something in the Excel file. So let me share the Excel file just to illustrate what I'm talking about. Yes, okay, so you have it here. Okay, so in the discounted cash flow model, which is yellow or mustard or whatever, what we calculate firstly is the market value of the assets here, what we call the enterprise value. Enterprise value. Okay. So we calculate the market value of the assets. Then we deduce the net debt. Okay. Net debt being debt minus cash. Okay. And so as you can see, the difference will be the equity. Okay. So finally here it's an indirect, the DCF is an indirect method because we evaluate the assets and we use the property that the balance sheet is a balanced document. Asset must be equal to equity plus net debt. So if we calculate the market value of the assets and we deduce the net debt, we can find the market value of equity. Okay, so this method is the one which is maybe more modern, more complicated as well. More complicated as well. So you will do that with Professor Chevalier. But I would like just to say to you that next chapter we will study together, which is capital budgeting. Is, you know, when we're going to calculate if when we invest in a project, it's a good opportunity for the company. So finally, what we're going to do tomorrow will be to do this asset valuation, but not for all the assets at the same time, but for one asset only. So what I mean is that what we do tomorrow in details, which is actually what you also have to do for the group work, would be also very useful for you to better understand the discounted cash flow model when you study that with Professor Chevalier in a few months in the company valuation class. Okay, so that's why I don't insist on this one. So coming back to my slides, this method that I just introduced, so you calculate the market value of the assets, okay? Then you deduce the net debt, which is debt minus cash, okay? So you can calculate the present value, the P0. P0 will be V0, V0 is the enterprise value, so the market value of the assets, okay? Plus cash minus debt, so minus net debt, divided by share outstanding. And so how do we calculate V0, which is actually the, you know, the value of the assets, is the present value of the cash flow you expect to receive from these assets. That will be finally the net income plus depreciation minus capital expenditure minus increase in net working capital. Well, actually, we're going to see that in details tomorrow. So it's no big deal if you don't understand that for the moment. We don't care. What is important for you to understand for the moment is that the way we're going to evaluate V0, which is the value, the market value of the assets of the company will be the present value of the cash flows we expect to receive from the assets. Okay, and this is this cash flow from the assets that we're gonna see into more details tomorrow. Okay, so this one we don't care very much. We're gonna detail that tomorrow. You understand that when we finish tomorrow. When the takeaway of this discounted cash flow model is really to understand what you have in the Excel file, which is where I come back now. Okay, the discounted cash flow model, we calculate the value, the market value of the assets. We deduce the net debt, which is the green one, to calculate the equity. Okay. So do you have any question about this presentation, this quick presentation of the DCF? Okay, so let's conclude with this figure, which is from the book 9.1. Here we have a summary of the three methods we discussed. The red one is the dividend discount model. So we take into account dividend payments to calculate the value of one stock price directly. Okay, so that was what we did before the break. Then we did some total payout method just after the break. This time, we take into account all the dividends and repurchases to calculate the total payout at the company level. And so we calculate the equity value, which is the market value of equity, which is also the market capitalization. And then only as a last step, we divide by the number of outstanding shares. And the green one is actually the discounted cash flow model. In that case, we're going to take into account the cash which is available for all security holders, which is generated by the assets of the company, to calculate the enterprise value, which is also the market value of the assets. Okay, and then we subtract the debt to deduce indirectly the value of equity. Okay, so these are the three models that you should more or less know because we discussed them, at least theoretically, even if we took some more time, for, of course, for the first one and the second one. The third one we just discussed theoretically. Okay, so please notice that you have these three models available, and that the most modern is the last one that you will discuss with Professor Chevalier. Why? Because if you calculate the value of the company, let me go back to my Excel to finish, to conclude with this point. In this DCF method, we calculate the assets, we deduce the debt to calculate indirectly the value of equity, right? So I see your question, I just come back to your question. So it's an indirect method, and so we do not need an assumption about the dividend payments in this DCF model. So that's interesting. At which point of time in the future should the V0 is picked? So we will see that with the project tomorrow together, but globally, what you do usually is that you consider that the company will exist forever. Okay, so the assets of the company, you will calculate precisely the cash flows of the assets during 5 years. And then from year 6 to the infinite, you will make an approximation using a growing perpetuity. Okay, so this is usually what we do. And so it makes a link with, you know, the example we did the first day together when we did I think it was the hot internet company. You remember the hot internet company? It was a tricky example. We had a growing annuity for 5 years and then a growing perpetuity. It was actually an introduction to this method. So this is usually how we do. And fortunately for us, we are lucky because when we work on the next chapter, capital budgeting, we're going to do exactly the same, but except of instead of doing that for all the assets at the same time, we're going to focus on one project. So really what we do tomorrow is very interesting. I really like this topic. It's also going to be very useful for you to link later on with the discounted cash flow model. Any other question about the this chapter? Yeah, you're welcome. No? Okay, so my proposition now is that we move directly to the next chapter, because I think technically the calculations are less complicated for this stock valuation chapter. So you have also exercises, right, that I shared with you. So I will send you the solution today, and you can train with that. But I think it's not very useful to redo that together. I usually, it's not only this year that I say that, and we never usually do exercises about stocks because it's not so complicated. So you can do it on your own to see if you understand well, and of course you can send me an email if there is a problem. Okay, so I will send you the solutions to the exercises about stocks so you can train. And if you're okay now, maybe we can move to the next chapter, which is actually, so you should see my PDF document now, if it's correct. Sorry, I'm not sure so I'm gonna put it in the other screen I have. Okay, and now I share it. Now I share it. Okay, so can you see the PDF document? Can you see the PDF document? You should see capital budgeting decision. Is there someone who could say to me, confirm to me in the chat that you can see it? Okay, thank you very much. Thank you. Okay, so now capital budgeting decision. So again, we are entering the chapter that's going to be linked to the group work. Okay, so today, like we have half an hour left, we're going to discuss the investment decision rules. So it's not directly what is for the group work. What is for the group work? Capital budgeting. So this is what we do tomorrow during 3 hours. Okay. Okay, so in this last part of the seminar, capital budgeting decision, what we do is we're gonna work, as I said, on one project. Okay, so company would like to invest in a new machine. Okay, and they would like to know if it's a good opportunity. So what we will do is that we're gonna think about what will be the cash flows associated with this project. Okay, and so we're going to calculate the net present value of this. Okay, so we're going to use the net present value as the main criterion. Okay, but there are also other criteria that I would like to discuss with you, at least the internal rate of return. This NPV, internal rate of return, are, in my opinion, the two most important to know and to, to manipulate, to work with. And I will discuss also quite quickly what we call the payback period, which is actually another tool, a third tool, okay, which is a number of years that we need to wait before it's profitable for the company. Okay, so globally it's interesting because the NPV is the value in dollars or in dons or in euros. IRR is a percentage, okay, and a payback period will be a number of years. So you will have 3 different expressions of if is it profitable or not. So it's interesting, and we'll see also we'll discuss quite quickly what we call the profitability index, just to show you that it exists. Okay, so let's say that for half an hour or 1 hour, I think we will discuss in details what are the different tools that you can use to evaluate a project, and then tomorrow we will see. We will go through the method together using an Excel template about how we can calculate the NPV of a project. Okay, so for the moment, let's discuss, some stuff about the NPV and everything. Okay, so we consider to discuss the NPV standalone project. Okay, so it means that it's not It's not comparing one project to one another. It's should we take it or should we leave it? Okay, so that's what we call standalone projects. Okay, so sometimes you will calculate the NPV to compare the NPV of two projects, and sometimes you're just going to calculate one NPV to see if it's positive, and if it's positive, as you remember, we go for it. Okay, so let's consider that we have one project. It's from your book, huh? So you can see more information in the book as well. So it's FFF, Frederick's Feed and Farm. Okay, so they invest, they intend to invest 250 million. Okay, and this project is expected, so it's a very simple project because the cash flow will be always the same, which is not what we're going to have tomorrow. But for the moment, we have this simple example. This project should be able to generate 35 million per year and forever. Okay, starting at the end of the, so it's a constant perpetuity formula. So if you understand well what is happening here, we can say that the NPV will be equal to investment we pay today. So that's the cost of the project, and the benefit of the project, that is a constant perpetuity, 35 divided by R. Okay. So of course, as we can see, the NPV is dependent on the discount rate. The higher the discount rate, the lower the NPV. Okay, because the 250 minus, they are not impacted by the discount rate because this amount is paid today. Okay, so if you remember what we did earlier today, you know, with the model of growth, like 12%, 8% for the investment of the project is higher than 10%. So this is what we are talking about here also. So if the rate is too high, meaning if the company is asking for too much return for one project, to some extent, it's not going to be profitable. Okay, so this is what we have to see. So firstly, if we calculate, so okay, I go on Excel. By definition, the NPV, must be positive. Okay, must be positive. Must be positive. So let's say positive. Let's say that for FFF, so let's say that the discount rate is 10%. Okay, so we have I0, which is minus 250, and we got C, which is 35. Okay, so the net present value will be equal to will be equal to 250. Okay, plus 35 divided by 10%. So in that case, the NPV is positive. So NPV is positive 100 if R is equal to 10%. Okay. So this is what we can say. So if the required return is 10%, our project is positive. Okay. And if we want to know how we can, if you want to know what is the IRR of the project, okay, what is the internal rate of return of the project, we can say that the IRR is the rate for which the NPV is equal to 0, meaning investment is equal, the benefits are equal to, the cost is equal to benefits. Okay. So can you calculate the IRR of this project for me here, please? And share with me in the chat. So if you understand well, it's minus 250 plus 35 divided by R must be equal to 0. So what is R in this case? 14% for Chang, 40% for Anne. Yes, of course, it's 14%, right? It's 14%. So R must be equal to 35 divided by 250, I guess. Just checking to be sure not to make a mistake. 14%, okay. So that means that so we have already calculated two investment rules here, okay. So we have for this project, we have the IRR and the NPV. And so as we said, the NPV requires that we have a discount rate which is provided by the company, which is a limit, a minimum not to go below. So we need at least our project to generate a return of 10%. And the IRR does not need that because this is the rate we are calculating, okay? So we calculate 14%, okay? So we could say that, I think I can go back on the PDF because I think this is written already on the PDF. It's no use to rewrite it. So this is what is done here. And so if the cost of capital is 10%, NPV is 100 million, okay. So they should undertake the investment. And IRR is 14%. So another way to put it would be to say IRR is higher. IRR is higher than the return cost of the expected cost of capital, okay? So we should undertake the project, okay? So these are the two things we can do. So certainly you will have to do it for your group work, calculate at least the NPV and the IRR of the project, okay? If you have the time, you can do the payback period and everything, we'll see. So why do I talk about this? Because of course, sometimes you can have conflicts in the results between the NPV and the IRR. So normally, in most of the cases, NPV and IRR will lead you to the same solution, like in FFF. Okay, so they will give you the same answer. We should undertake the project. But sometimes it's not the case because of the pattern of the cash flows. Okay, so it's not very important what I'm going to discuss now, but it's just to show you in which cases it can be a problem. Usually, let's say that if you have the typical situation where you have the investment at the beginning of the project, meaning the negative cash amount at the year zero, and then positive cash amounts, usually NPV and IRR will go in the same way. They will give you the same answer. So there is no conflict. But sometimes you can have situation where, well, mathematically, we have a pattern of the cash flow that, leads to some conflicts between the NPV and the IRR. So let's just discuss that very quickly so you see when it happens. Okay, so sometimes alternative investment rules may give the same answer as the NPV, but sometimes they may disagree. Yes, so maybe, okay, the first takeaway is to say that if you have a different answer when you use the IRR and the NPV, the one you should use is the NPV rule. Okay, so the number one rule is the NPV rule. Okay, IRR is only number two. Okay, so the most important one, NPV. Okay, so that's the first takeaway. So as I said, the internal rate of return is the, so we should take an investment when the IRR exceeds the cost of capital. So this is what I shared in the chat, 14% is higher than 10%, okay? But sometimes the IRR rule may disagree with the NPV rule, and so it's not correct to use it, okay? So what are the typical situations where we have this conflict? Usually when the investments are delayed, okay? Because mathematically, investment will come afterwards, so it's gonna invert the signs of the cash flow, so it's not easy to read. Sometimes you will have non-existent IRRs, and sometimes you will have multiple IRRs, so not easy to take a decision in those situations. So let's have a look. So firstly, delayed investments. Okay, delayed investment. So assume you just retired as a CEO of the successful company. Okay, a major publisher has offered you a book deal. Okay, so the publisher will pay you. The publisher will pay you 1 million upfront. So you receive 1 million. If you agree to write a book about your experiences. I wish it happens to me someday. I'm not sure nobody will pay me 1 million for what I have to say, but maybe I can dream. You estimate that it will take 3 years to write the book. Okay, so we have a certain number of years. Okay, the time you spend writing will cause you to give up speaking engagements of $500,000 per year. So this is something we will rediscuss tomorrow, but this can be considered as a cost for you. Because when you take the decision to write the book, you will not have the time to do something else. So because you take the decision to write the book, the consequence for you will be positive today, you will receive 1 million, but negative tomorrow because you will not receive 500 per year during 3 years. Okay, so this is what we call opportunity costs. Okay, so these costs have to be considered in the project because they are the direct consequence of you taking this decision. Because you take the decision of writing the book, you will not receive 500 per year during 3 years. Opportunity cost of capital is provided 10%. So okay, I don't have the cash flows. I thought we had a timeline, so I'm gonna express this this on a timeline here. So we got the year 0, 1, 2, 3. So it's minus 1 million. Okay, let's put it in K dollars. Okay, let's say K dollars. And so you receive sorry, I'm mistaken. You receive 1,000 today, and you will not receive 500 during 3 years. Okay, during 3 years. So in that case, so R is 10%. Okay, so I should be able to calculate the NPV using the formula. So let me calculate it. So the rate is here, the value is here. I will explain you how to calculate that in more details tomorrow. So it's not a rate that I would like to calculate, it's an amount. So it should be this minus 200, and so the NPV is negative normally. Okay. And the IRR, if I go in my formula again, and I use the French version of it, so it's 23%. Hopefully, I hope my calculations are correct. If not, I will be ashamed because I don't find the same thing than in the slides. So I stop sharing and I check. Okay, so yes, so the rate, so the provided rate is 23. Okay, so the internal rate of return is 23. Okay, so the IRR is greater than the cost of capital. Okay, so the IRR rule indicates we should accept the deal. But that was correct, my calculation. So the NPV is negative. Okay, so if we look at the IRR rule, it's okay because 23 is higher than 10%. We should go for it. And if we go for the NPV, it's a negative NPV. So we should not accept this project. Okay, so here we have typically a situation where the NPV and the IRR do not give you the same answer. Okay, so again, in that scenario, you should first take into account the NPV. So you should reject this investment. Okay. So this is how it shows graphically. Okay, so when the benefits of an investment occur before the cost, the NPV is an increasing function of the discount rate. So the line or the curve is going in the opposite way than usual. Okay, because usually you would have something decreasing when we have that, like we had earlier. Okay, this one is more easy to understand, right? As long as the the discount rate is lower than 14%, the NPV will be positive, and for any value afterwards, it will be negative. Okay, so that's economically understandable. Here, it's not so easy to understand because we have the opposite situation. Positive amounts first, negative amounts afterwards, which is not usually what we have when we have a project. It's just to show you what happens. Now let's see a different situation. Suppose now that so it's the same example. They just change one data. So we see a different situation. So now we're going to see multiple IRRs. Okay. So suppose a star informs the publisher that it needs to sweeten the deal before, and it will accept it. So the publisher will offer 550 in advance and 1,000 in 4 years. Should we accept or reject the offer? So if you solve this, you will find 2 IRRs actually. Okay, I don't know how it works, by the way, in Excel. Let's be curious. I never did it because, you know, usually when I do these examples, I'm in the same room with you, so I just write on the board, so I never go in on Excel. This year I'm on Excel, so okay, let's have a look what it gives. I don't even know how Excel would calculate this. What the solution is going to provide. So I think we have a 4th year here. So let me just have a look about the data. So the publisher gives you 550 in advance. You should see my Excel, right? 550 in advance, and we have a 1,000 in 4 years. Okay. So now if I take the NPV, so this one, okay. Okay, the NPV is negative, and the IRR. So what does it say for the IRR? It gives only 1. Okay, bon. So not very satisfying. Sorry, 7%. So it gives only the first one. Good to know. Good to know. If you focus on it, see, when you're only on Excel, if you trust Excel to do the job for you, then you don't have exactly the solution. So two IRRs, 7.16 and 33. So you should see the PDF now. If not, please tell me. And so you have this curve. Okay, so now you should have on the screen a curve, which is a U-shape, what we call a U-shape curve. Okay, and we can see that for any values of the rate which is lower than 7.16, you have a positive NPV, but you also have this situation if the IRR is higher than 33.6, which is economically not very easy to interpret, right? So when you have multiple IRRs, so between 7.16 and 33, the book deal has a negative NPV. Okay. Yes. Since your opportunity cost of capital is 10%, you should reject the deal. That's true, because we only go for the NPV rule, and the NPV rule is for 10%. Prof, when you use Excel, can you use English version? And so we can see how you do it. Okay, so I will try to change that tomorrow. I will change that for tomorrow. Okay. Okay. So last situation, non-existing IRR. So finally, we have a third situation where we have another. So let's see if I can quickly change the language. I don't know where to find the language. So I will wait for tomorrow because I don't want to lose time doing that now. Okay, so now we have the third situation when we have non-existing IRR. So let me share my Excel. Just for you guys to know about the formula you should use in Excel, one is called NPV and the other is called IRR. Okay, so that's the two formula I use. This one is NPV formula, and this one is IRR formula. Okay, so if you want to see already, you can see for these two formulas. And so the third situation, as we have, so now we increase the advance to 750. Okay, and we, in addition to the 1 year and the publish in 4 years. Okay, with this situation, we can see, okay, it says number in French. So it means that we cannot find any IRR in this situation. Okay, so coming back to the PDF. So in that case, you can see any situation for the rate gives a positive NPV. So because the NPV is positive for all values of the discount rate, we cannot use the IRR, and we should accept the project. Okay, so these are the first thing we could say about this. We could say that be careful. NPV and IRR are the two rules that you should use, but that's true that be careful that they go in the same direction. Normally, like a project you do tomorrow or Thursday, you should not have this problem, because if you have the negative cash flows first and positive cash flows afterwards, which is usually what you have for a project, you should not have any conflict between these two rules. So you should be able to use NPV and IRR. If you have any conflict, do not forget NPV goes first. Another rule that you can use is what we call the payback rule, or the payback period. Okay, so the payback period is an amount of time that an amount of time that it takes to recover or pay back the initial investment. Okay, so if the payback period is less than a pre-specified length of time, you accept the project, otherwise you reject the project. So the payback rule is used by many companies because it is very simple. So in which case use IRR is better than use NPV? I would say never. I would say never, because the NPV is always goes first. But we will see that sometimes can be useful when you don't have the same size in the project. Usually when I don't have the same size in the project, maybe sometimes I go for, I look at the IRR. Because if we take an absurd example, on one hand, you have one project that is 1 million of investment, and the other, you have only $10 of investment. Okay, of course, you will see that the NPV maybe will be higher for the big project than for the small project, but the IRR will be different. But globally, the question is, how much is your budget, right? What is really your budget? And so when you want to compare projects with different scales, sometimes it can be interesting to look at the IRR first. Okay, so but be careful, because of course it depends on what is the budget you have. Does it answer to your question, Kian? Okay. So coming back to this project we have here. So now we come back to FFF project, right? And assume that requires all project to have a payback period of 5 years or less. Should we undertake the project fertilizer under this rule? So what we do here is, do I have FFF somewhere? Yes, FFF. So for the payback period. So we say investment is 250, cash flow received is 35. So what is the payback period? Well, you just do the absolute value of the investment, okay? And you divide that by 35. So it takes 7.14 years to pay back this project. And so they say in the, oh, sorry, you don't see my Excel, sorry. Okay, I begin to be tired, maybe. Okay, so I forgot to share my Excel. So what I did, okay, so I say payback period. So I take the investment of the project is 250. The cash flow I receive every year is 35. And so I just did, okay, absolute value of 250 divided by 35. So it takes 7.14 years, 7 point something years to be able to pay back this project, okay? It's more than 5 years. So we should reject the project using this rule, because what they say in the slides, if you have a look at the slide, they say, assume Frederick's requires all projects to have a payback period of 5 years or less, okay? Would the firm undertake the fertilizer project under this rule or not? Well, theoretically, no, because it takes 7 years to pay back. And of course, it's more than 5 years, so we should reject this project. Is there somebody in the chat who could tell me why this payback period is not such a good tool to use? What are the defaults of this method if you calculate that the way I do? So it's very used in practice. I have been discussing with some students from previous batch in Idbv, and they were saying that, wow, my boss is using a payback period, and now I've been able to convince him that it's better to use NPV. And so of course, it's very simple to calculate, as you can see, but now we'd like to see in the chat someone saying to me why it's not a good method to use. At least one student would like to try to say to me why the payback period is not a good method to use, the way I calculated. Somebody take the risk, or maybe you don't see or you don't understand my point. Again, to calculate the payback period, just take the investment and divide by 35. Okay, so I consider that 35 in 1 year is that's the same thing than 35 in 2 years and so on. So it's not good because it does not take into account the interest rate. That's right down. It doesn't take into account the time value of money. Okay, so it does not take into account the project cost of capital and time value of money. And of course, it ignores the cash flow after the payback period. That's true. So that's true. It doesn't take it. So it's not good. Okay, it's not good. So we are finished with the payback period. Okay. Let's say that if we consider what we call a discounted payback period, so we take into account payback period. So we still have one investment 250, okay, and C is 35, but now we're going to consider R of 10%, okay. So sorry, okay, 10%. Okay, so in that case, you would say that minus 250, okay, so that would be 0 is equal to minus 250 plus 35 divided by 0.1, okay, times 1 minus 1 divided by 1.1 exponent n, okay. So it means that you could calculate the discount. So in this formula, we calculate the discounted period, but with taking into account the time value of money, because since we have 35 every year, so it's a constant annuity formula. So the question would be how many years n should we wait before having paid back the 250? Okay, So it's 9:59. So I don't want the answer now. Okay, so you calculate that for tomorrow. And so that will be the introduction of the thing that I will give the solution for this one. Okay, so I don't want you to rush. I want you to rest and have a good day at work tomorrow. So you just do this little calculation for tomorrow, 7 p.m. and we discuss the result together. Okay, so this is it for today. Thank you for your attention. Thank you for the interaction on the chat. I hope you like this session. And we see tomorrow to go on with this capital budgeting chapter. And in between, have a nice rest of the evening and sleep well. Okay, see you tomorrow. Bye-bye. Thank you. Goodbye. Goodbye here. See you tomorrow, me. Bye-bye, Chang. Have a good night, Long. Thank you, Chang. Thank you, Dong. Goodbye. See you tomorrow. Good luck, everyone, for work tomorrow. Enjoy your evening. Thank you, Han. Okay, I'm quitting now. I will put the video soon online. Cheers.